Good morning, everyone, and welcome to the session today. We're joined by Ailsa and Marek, who are co-managers of International Biotechnology Trust and have been since March 2021, having taken over from Carl Harold Jansen, with whom they've worked as a team since 2014. The managers see their experience and depth of medical and scientific knowledge as a key edge over the competition. Year to date, IBT has outperformed peers such as Biotechnology Trust by a wide margin. IBT represents a specialist exposure to an area of the market that offers the prospect of strong capital growth over the long term, backed by numerous secular trends. However, IBT also pays a dividend from capital each year of 4% of NAV, which provides a very differentiated exposure for income investors. We've got around 30 minutes for the formal presentation and then 15 minutes available for questions. Your microphones are muted, but you can ask questions by using the Q&A function, which you should be able to see at the bottom of your screen. I'll put your questions to the managers at the end of the session, so please do make use of that function. There are quite a number of people attending this session, so please don't be disappointed if we don't ask your question. All questions will be shared with the manager, and we'll do our best to get answers back to you using the miracles of the internet and technology to everyone who asked them. So without further ado, here are Ailsa and Marek.
Thank you, Billy, and thank you, Kepler, for inviting us to present today. We're going to start the presentation with an intro to the team. So on the next slide, you'll see the 4 members of SV Health Investors that work on the trust. Marek and I work on the quoted part of the portfolio, which makes up approximately 90% of the trust. And Kate Bingham and Human Ashrafian help out on the venture side of the portfolio. Moving to who SV Health Investors are. So SV Health Investors, an umbrella firm, they're mostly a venture cap firm, but all investments are in healthcare investments. They have an over 27-year track record, founded back in 1993. And over 50 professionals within the company. They have an AUM of over $2.5 billion US, and this is spread across various different venture funds, including International Biotechnology Trust, which is the public fund within the firm. So the presentation is going to be split into 2 sections. The first section will be talking about the fundamental sector drivers of the biotech industry and the current themes, and Marek will be doing that part of the presentation. And then I'll come in for the second half to discuss the trust in particular. So Marek, over to you.
Thank you, Ailsa. So I just wanted to start off with talking about the fundamentals of the sector in general. So we have had a lot of swings in the equities markets when it comes to biotech and pharma during the last 2-3 years. But I would just want to come back to the fundamentals, what is driving long-term the evolution of these sectors. So this slide, you can see that population-wise, it's a demographic shift we are encountering at the moment, and will be continuing for a foreseeable future. And this slide shows you the population above the age of 55 in the US, which is a proxy for the Western world. It constitutes around 30% of the population, but the healthcare spend is almost twice as much per capita. And if you look at the next slide, you can also see that population cohort is growing very quickly and will double or triple over the coming generations. Also adding to that, we have an emerging markets where the growth of population and also graying of the population will contribute to the continued demand of new drugs that can address diseases currently not met. And if you look at the next slide, on the left-hand side, it's showing that the supply from the industry, meaning the number of ongoing clinical trials during the last decade has more or less doubled, which shows you that the industry has responded to this long-term demand from the sector. On the right-hand side, you can also see number of approvals that are slowly but surely growing, and there is always a lag because one should be aware that from the time you start clinical trials to getting approved, it's between 5 to 10 years. So we have good hopes we will see more drugs coming through by just looking at the number of ongoing clinical trials. So the sector is in good shape in general. And if you look at this slide, shows the pharmaceutical sales globally over the last decade and projections forward. And with recessions, with wars, with pandemics, we can see that hardly that sales numbers are dented. It just shows you that 2021 we had the pandemic. Actually, sales grew mostly because of the vaccines adding to the sales top line. But the industry is very resilient in downturns. You should be aware that when we have this inflationary and high interest rates environment maybe coming through, this is what you prioritize: food, shelter, and medicine. This is what you prioritize. You don't prioritize another subscription or a Peloton bicycle. This is what you prioritize. This is what we believe this industry, especially the part of the subsector of the industry which generates revenues and profits, will withstand some of these recession rumbles we hear around. So next slide will show you the equities markets, how that has performed during the last. This is a slide from March 2021. The light blue graph shows S&P 500. The dark green represents the Nasdaq Biotech Index, which is a market cap weighted index of the biotech sector in the US, and is our benchmark. And the light green is an equal weighted, same index but equally weighted, showing that the smaller names have more relative weight, and they constitute around 360 companies. As you can see in this slide, we were out very early in 2021. If you read our blogs, we said that this market was overheated when it comes to biotech. This slide doesn't show what happened in 2020 during the pandemic, but from the nadir, the bottom of in March 2020 to peak in February 2021, the biotech index went up around 100%, or give or take. So we thought that was overhyped. We had a lot of investors that were running into these hot names. We had a lot of liquidity in the markets through QE from the central banks, and they want a quick buck. But knowing investing in biotech, it's a long run. So short term is what equity markets work for you, but in the long run, you need to think about the fundamentals. We saw in November here that we had another leg down, and that was more macro-driven than biotech-driven. And we saw that it tends to be so that biotech, since it's considered relatively risky business, it tends to be a leading indicator of what will happen in the rest of the industry. So when we have a potential upturn, biotech seems to be the first subsector that reacts to positive numbers. If you see the next slide shows you the evolution, what happens in the biotech sector. We have been through several of these evolutions after the dot-com boom and bust, 2007-8 financial crisis. What tends to happen is that I would start with stage 4, which was late 2020. We had hyped valuations, we had boom in biotech, a lot of IPOs coming through. The sky was the limit. Then it tends to move to stage 5 in this slide, when M&A dries up because valuations go up so much, so the pharma industry do not want to buy them at these valuations. Suddenly, the people tend to sell off because we have reached a certain peak. And then after that, the sector tends to move down. Company values are depressed, IPOs start to dry out. And this is what we are kind of at the moment. And stage 2 usually tends to be kicked off by M&A, meaning mergers and acquisition, when pharma starts to move in and buy companies on the cheap, at least at valuations that they feel are reasonable. We have seen signs of that, but this will also be dependent on what happens in the rest of the economy. One should be aware that, of course, biotech is a sector that is dependent on the real economy and the rest of the world as well. So we are cautiously optimistic, but I think the valuations are very, very depressed at the moment, and you have seen on the previous slide. And these revolutions happen, just usually takes 3 to 5 years, but we have seen during the 24 months from boom to bust within just 12 months. And it has never happened before, at least not in my life. And this is why we feel that this COVID pandemic situation is very, very extraordinary, and maybe we will normalize it going forward. So coming back to the M&A situation, pharma and biotech are in like live in a symbiosis between each other. Pharma is really good at selling drugs, distributing them, and make profit and squeeze out the best of or the most of the drugs available. Whereas biotech, really good at innovation, getting ideas into the clinical trials, but less efficient at executing global clinical trials and actually selling the drugs. And this slide shows you that during our fiscal year, which starts September 1st, we have seen 5 companies being acquired in our portfolio. Normally we see 3 to 5 per year. We have already seen 5. And this shows you that on the previous slide, that the evolutions, that it seems like M&A is actually starting to pick up.
Thank you, Marek. So this slide, we try and pull together all of the various different risk factors for the sector, some of which rear their heads at different times. For example, drug pricing tends to be an issue for the sector. It's continuously a sort of overhang and a threat, but the drug pricing very much is related to elections in the US. So as and when we approach a US election, you will hear more about issues of drug pricing. Equally, FDA, we had a situation for a long period of time where the FDA had no leader, no commissioner. There has now been a confirmed commissioner, so that we can put to rest. COVID has been a risk for our companies, clinical trials having to stop, etc. Again, this issue really is behind us, we believe, and we're returning back to normal. M&A has slowed down during COVID, probably as a result of lack of face-to-face meetings, but also because valuations were really quite extreme at one point. So maybe that's another reason why pharma hasn't been coming to the table. That, of course, is now corrected somewhat. And then the FTC, finally, there were some concerns that the Competition Commission over in the US would stop mergers and acquisitions if it was deemed uncompetitive, but really that hasn't materialized. So something that has lessened as a risk. So this next slide discusses the current themes, and I think the takeaway from this is the biotech industry itself is very much business as usual, huge amounts of innovation. This has been going on for 2 decades now, and we don't see this changing in the next 2 decades. Science is evolving and growing. And what we've got on this slide is some examples of 4 what we call platform technologies. And a platform technology is a technology that can be applied to develop drugs, which can be applicable across many different therapeutic areas. So it's a compounding of new drug potential. So on the left-hand side, this is cell-based therapies. And this is where a patient's cells are extracted. Those cells are manipulated to, say, target a specific tumor and kill it. And those cells are then reinserted back into the patient. This technology isn't new. There are drugs that are approved and on the market today and selling. Portfolio companies in IBT called Kite and Juno were acquired by big biopharma names, Gilead and Celgene, to access these technologies. And then we're going to see next generation cell therapies that are cheaper to manufacture or more effective in their efficacy in the future. 2 other examples of platform technologies, gene therapies and RNA therapies, both of which have been very much in the press of lately. These again are proven, they are on the market and selling, but there are new generations of these technologies addressing different diseases in the pipeline. And then finally, the last example we use of a platform technology is gene editing. This hasn't been approved and on the market as yet. This is very much still in the pipeline, but this is the next sort of generation of innovation to come. So the next part of the presentation, I'll talk through the trust. The first slide, we talk about the performance of the trust in terms of NAV, which we're holding up well against our benchmark, and the benchmark is the NASDAQ Biotech Index. And then we also show how the share price has performed. We're currently trading at a slight discount at the moment. I'll talk about how we manage our discount later on in the presentation. So the next slide, all this information is put on our fact sheet each month, including our performance. And this slide just shows our volatility. So this is something that we absolutely do keep an eye on at IBT. We have various different approaches to how to manage down volatility. As you know, biotech is incredibly volatile anyway. So we're quite proud of the fact we've managed to keep our volatility at a relatively low level. So what is our investment process? We get our ideas from investor and medical conferences. Actually, Marek and I are going over to the US in next week for the first in-person conference since the pandemic. And there we get to meet our companies in one-on-ones and then meet new company ideas for our investments. We have various different sources of research and to be able to cross-examine the investments that we make, both internally at SV and also external KOLs. And we've recently started a 3-person scientific advisory board consisting of 3 key opinion leaders, KOLs stands for key opinion leader, that gives us a great deal of helpful insight into any potential investments that we may make. In terms of risk mitigation, we have a system where we will reduce our position in a company if we're going into a clinical event or a regulatory event that we deem as risky. That's one way of keeping our volatility down. We are incredibly valuation sensitive. So although if we we're really encouraged by a new technology, we won't just buy it and not take into account the valuation of that company. Some of the CRISPR companies a year ago were trading at over $10 billion in market cap, despite not having any clinical data. That was something that we were concerned about at the time. And then equally, we have trading discipline. So if we feel a company has reached its full value, we will trade out of it and then buy it back if it sells off. We do also have one eye on macro, so we will reduce positions in various different risk profiles within the fund in order to mitigate our volatility in the business cycle. And we can also use our gearing facilities. So because we're a closed-ended fund, we have the option of using gearing to invest in companies and not having to sell another investment to fund that. The next page, this is another thing that we will report every month in our fact sheet on our website. This just shows the diversification that we have within IBT. So we are investing across the whole spectrum of the industry, from new ideas out of university and the venture side of the business, which Kate Bingham manages, all the way up to the mega cap companies like Gilead and Amgen. And the top left-hand slide just shows the proportion within each of those buckets. On the right-hand side, we've split the fund into companies that have launched a drug, they've been through the clinic successfully, they've been through the regulator successfully, they're on the market, and they've turned a profit. So 23% of the trust are in those names. 35% of the trust have gone through the clinic, gone through the regulator, they're selling, but they haven't yet turned a profit. And the rest of the portfolio, 42%, are in the early stage pipeline companies, the more traditional biotech names, if you like. Areas that we like to focus on are rare diseases and oncology. So bottom left, you can see that almost 60% of the fund are in those 2 areas. We like those areas because we think that's where the pricing power is. And then in terms of geography, we are mostly invested in US listed assets. I mentioned earlier about should we just switch? Can we just quickly do asset allocation? Did we miss that?
Yes, coming.
Oh, sorry. Okay, sorry. So this is our top 10. I'm going to speak a little bit more quickly because of time, but ultimately you'll see at the end of the last month, we had a large investment in Biohaven, for example, which has just been recently acquired by Pfizer. So that's been a huge help to us in terms of performance. A number of the companies we feel on this list are potential candidates for M&A. Marek spoke to how we expect M&A to pick up now that we've had this big correction in the markets. Mirati, Insight, Ultragenics, all names that we think would be attractive to big pharma. The next slide, we talk here about our asset allocation. So we can switch, and we do switch within smaller companies and larger companies, depending on where we see value. So a year ago, we felt small cap companies are very overvalued. And the left-hand bright turquoise bar shows the proportion of the fund in small cap companies. That number has dramatically moved higher at the expense of the larger companies. We're seeing exciting new innovation becoming a lot more cheap, a lot more better value, if you like. So we're stepping into those companies. This slide, I mentioned that we do actively manage around our discount and premium. The board introduced a dividend back in 2016 in order to increase the demand for our shares and increase the pool of investors into income as well. And that massively helped reduce our discount and also stop our buybacks at the time, which was shrinking the fund. And then we also do issue if we do trade at a premium. So it's actively managed in that front. The dividend, it's pegged to NAV, 4% of NAV. So if the size of the fund falls, then obviously the dividend payment will fall. And then the inverse is true, as the fund grows, our dividend payment will grow. The way we see the dividend payments, we don't have a natural income coming in from our companies. Most of our companies are growth companies, not income companies. So it comes out of capital. But as and when we see M&A, that's where we get cash in from our investments. So obviously lately we've had this big deal for Biohaven. That's a big cash injection back into the fund. And just to summarize before we have questions, we do believe biotech fundamentals are very much intact. It's a really exciting time to gain exposure to this sector in our view, especially with valuations having this marked correction. The companies and innovation are still very alive. Risk management we address on various different approaches, both top-down and company-specific. Backed by the expert team at SV Health Investors with a 27-year track record. So obviously as an investor, you get access to the growth of the underlying companies, but also income from our 4% dividend each year. So now I'll hand over to Billy for some questions, if we've had any.
Thank you. Thank you, guys. We had a few questions. Any more questions, please do type them into your machine. So first up, gene editing. Is there any exposure within the IBT portfolio to any companies that are doing gene editing?
Yeah, I can take that. There are several companies in if you looked at our fact sheet and our quarterly reports, you can find our exposure that varies over time, of course. But to this specific question regarding patents and exclusivity, normally this is what happens when a new technology evolves. This happened, exactly the same situation happened when the antibody was developed. You had companies owning certain patent estates and exclusivities. So it's normally going over time shake out, and what tends to happen, you have cross royalties because to this question, editors have exclusivity on certain parts. There are like Caribou and CRISPR technologies that have patents on certain other items. And what tends to happen, you bunch that together and have a cross royalty and you pay a certain amount. I think when I worked in the industry, antibody production, you had to pay like 2-3% royalty to the inventors of certain technologies. So that's kind of the normal way of doing it. It's cumbersome, painful, and for an investor, kind of it ebbs in and out. Yeah. So
we do have exposure.
Yeah, we have exposure to gene editing, but that differs over time.
Billy, we can't hear you. On mute.
Sorry. I'll get used to this. After 2 years, you thought I'd have got up to speed. You mentioned the recent acquisition of Biohaven. Was it an M&A play, or did you like stock for its own fundamentals?
Yeah, so we first met Biohaven about 4 or 5 years ago, I'd say. And generally what we do with a new investment is we'll take a small position in the fund, get to know the management team, get to see their technology, work through the clinic and become de-risked. And in that situation, you can increase the position in the fund because it becomes de-risked and they prove themselves. And that's exactly what we did. So we've owned them for a long time. We felt Biohaven became very expensive about 12 months ago. And we reduced our position, so it sort of speaks to how we actively manage the positions in the fund. And then Pfizer came and did a deal, a partnership, and the stock actually fell because there was M&A premium in that company. Since then, you'll see from an RNS that came out recently that we added to the position on the back of a share price pullback. So we're actively trading around this position. So yeah, we've known them for a long time, and it was great to see that they'd be acquired and succeed in that sense. We didn't own them purely because they were M&A, but if the value came back and you saw that it could get picked up, we added to it.
Thank you. And then as regards clinical trials and companies running into a clinical trial, can you describe your process if there's a poor clinical trial? What your process indicates?
Yes. So in terms of our binary event strategy, we know roughly when these clinical trials will read out. So part of our day job is to speak to our companies. When are you going to read out phase 2? When are you going to read out phase 3, or what have you? And we'll reduce going into that readout if we feel that's going to be a material move to the share price. So it wouldn't be a case of how would we manage the situation if it's blown up behind us. It would be if a trial is good and positive and we've scrubbed the data, spoken to KOLs, we would add the position post that. If a clinical trial is negative and reads out poorly, we would not buy the company back.
Thank you. There's a few questions on gearing, and I guess potentially, well, there's a few questions about your approach to gearing and when you might increase gearing, but maybe you can use this year as a sort of example of how you approach gearing.
Do you want to put that slide back up? Yeah, so we have this gearing facility. We won't go higher than circa 15% gearing. We may do, but we won't. That's sort of where Marek and I are comfortable at. And what we do is we very actively manage it. So, and if there's a big crash in the market or a very, very bad day, and we see some of our companies that we like, there's fundamentally nothing wrong in our view, no change, it's a macro news, for example, we'll use our gearing facility to invest more in that investment. And it means we don't have to sell something at the same time. So it's very active. You're going to see this bobbing around. We saw an initial very harsh crash going into February time, and we upped our gearing. And because we've been around, we've seen crashes before, we know that you'd expect a bear market rally, and we can exploit that by taking our gearing off and then putting it back on. What this shows you is just the snapshot, the sort of balance sheet of every end of month. It doesn't show you what's happening intra-month. So although it may see sort of mid-single digit gearing at the moment, that may not reflect what's actually happening in the fund intra-month, if that makes sense. But at the moment, just means we are using the gearing facility and it's active and opportunist, if you like.
Thank you. And then to what extent do you actively interact with or work with the companies you invest in?
On the larger companies, effectively zero. We meet them, I'd say, and or talk to them these days by phone, probably 4 times a year on the larger names. Completely the opposite for the venture side. So Kate Bingham and Human Ashrafian can have board seats on these companies. They work very closely with them. So the whole spectrum from hands-on all the way to very much hands-off.
I can add, we have approximately 200 meetings a year with different companies, and to Ailsa's point, the more we invest in companies, the more closely we are to them. So you need to graduate into our portfolio. If you have a small position, we meet the companies. We need to meet the company at least once or twice before even engaging with them. And then when we do, we start maybe with a very small position, and then they will graduate by showing their performance to us, that they actually deliver what they say, and over time they graduate. Biohaven is a very good story from that point of view. We started 5 years ago, and gradually that company increased in our portfolio.
Thank you. One technical question about the obviously IBT has an exposure to unquoted companies. How are those companies valued?
So the unquoted companies are valued on a daily basis. If there's something material that changes, they will be changed instantly. Otherwise, you'll hear about that in our interim report and our annual report. There's a lot more detail as to what we can talk about within that on those valuations. And then there's some companies within the unquoted pot that have IPO'd, and those will be marked to market, obviously.
Great, thank you. Can you talk about the sources of the dividend? Do you sell shares to pay for it, or do you keep cash reserves?
So we don't have cash reserves. We are very active on trading generally. So 2% dividend payment twice a year doesn't really kind of move the needle for us. The way we think about it is we have a lot of cash coming into the fund. It's unpredictable. We can't say this is going to happen in the future, but we do have a lot of M&A. It's naturally what you'd expect in this sector. We've had 5 deals so far this year. The Biohaven money that will come into the fund basically pays for the whole dividend for the whole year. So that's how we think about the money coming in to pay for the dividends.
And then the biotech industry as such do not pay dividend in general. Only the larger cash flow positive and relatively slow growing companies do. So this is one way of turning cash to our shareholders by M&A.
And a related question on M&A activity. I mean, are you expecting things to be impacted by the current sort of market malaise, or are these bigger firms more likely to respond to valuations and buy them or engage in M&A?
Very good question. So I have my background is in M&As and business development. So my experience from companies and up and downturns in the market is that as long as these small biotech companies are well funded and have high valuations, they don't want to engage and sell themselves. But in this environment, where we have had a sharp correction, and many of these companies will run out of cash eventually. They are relatively well financed, but in this environment, if you're going to raise money, you have to take a proper haircut. So we have a new paradigm, and it has been ongoing for 6 to 12 months now, and that means that in a way, buyers and sellers will start to meet. And I think Biohaven, coming back to that, if you think about the price they paid, was an 80% premium almost, but that price corresponded to the valuation that was in February. So it just shows you how quickly the expectations change. And this is why we believe some of these pharma names will pick up companies, and they need to accept the new reality.
And just to finish on that, you have to remember that there's been a huge cash generation from the COVID vaccines and treatments. And this is probably why Pfizer has been so active, buying Arena, another company of ours, and then most recently Biohaven. And they've been very public at how they're going to continue to look for new innovations and new sales to offset the IP that all these big pharma companies are facing in the next 5 to 10 years. They desperately need to fill that void through M&A. So we will probably see more use of the COVID cash to be buying up some of these bio names.
Interesting. Another sort of more macro question is, there's a sort of broad thought that, there's going to be more onshoring and de-globalization, and given the sort of political instability. But does that have implications for the biotech sector? And what are you seeing companies doing about this?
Yeah, I mean, it's a really good question. But one thing is that when you conduct trials, you tend to think about where will you get it approved, and that's US and Europe is majority of the market in the world. So when you conduct trials, you make sure that the FDA will accept the file sent to them. So many of the trials are conducted in the US and in Europe. Ukraine might have been affected for European trials, but when you conduct global phase 3 trials, you have many sites, so you close them off and maybe open up other sites. But coming back to the inflation and onshoring, pharma will always be global, but always local. Majority of sales in the world is in US and Europe, the majority of profits. Because the industry works like the most innovative drugs are sold primarily firstly in US and Europe, because the emerging markets cannot afford the new most innovative drugs. And I think we had a blog 2 months ago, you can read it on our homepage, when we actually discussed this globalization and where the profits are coming from.
Thank you. Finally, unless there's any other questions coming up, do put them in if you've got them. We've got maybe a little bit more time. But again, interest rates, is that going to fundamentally change the landscape for you?
Yes, they will, definitely so. Because if you think about this industry have evolved, fortunately, during the last decade. Now, 15 years ago, I would be much more worried in the sense that we would have had more small caps, non-profitable companies, and they will be affected badly by higher interest rates. Nowadays, what we have done in our portfolio, focusing more, as you saw on our portfolio holdings, profitable companies, revenue growth companies are the ones that might fare better because they have already taken all the costs in terms of clinical trials, taken all the risks, meaning the regulatory risk, the commercial risk will still be there. But selling a drug is 95% profit margin in a way, because the cost lay in the risk they take developing it. What might be affected, which is what we have already seen, are the early stage companies, not fully funded. When they have 5 to 10 years to market, they have all the costs and risk ahead of them. And in a high interest environment, with the risk-free interest rate going up, revenue streams in the future will be discounted much harder. So this is how we view it. And interest rates are going up, so we are prepared, hopefully prepared. But of course, everything will be affected, and we have seen the whole equity markets being affected.
I suppose in that context, given that it's going to be harder for smaller companies, let's say, to access capital going forward at attractive rates, are acquirers driving a very hard bargain? And would you expect sort of premiums to current share prices to be less large than they have been historically?
What tends to happen in the sector, which I just want to go back to what happened in 2007, 2008, when I was working in the private and companies. What tends to happen first is that you cut down on staff. Secondly, you try to license regions or certain projects in your portfolio to retain, lower your cash burn, and increase, potential take out risk of your portfolio, maybe cull some of the early stage projects so you can focus. And we have seen that happening already. People cutting staff. Premiums will probably stay very high because no biotech company will accept a 20-30% premium unless they're really, really in desperate mode. But historically, we've always seen 80% wasn't there about premiums when you acquire companies. Maybe they have gone down 50% and go up 80% from that, but still you very often pay a premium.
Thank you. And then I guess finally, you were mentioning the developing world. Are companies you invest in actively developing treatments and therapies which are benefit to the developing world, and is there a sort of ESG angle here?
So historically, which absolutely we can talk about, HIV I think is a really good example, where new oral synthetic drugs showed massive efficacy of turning what was a death sentence to a chronic disease. And those medicines have come off patent and ultimately are very, very cheap to the developing countries. And that gives you a really good kind of case study, an example of how the system works at the moment. It's a capitalist system, and ultimately it's a deal with society. So society has a deal with the pharma industry, which is, pharma, you have free pricing for 10 years, but after that you need to give your drug to the world for pennies to the pound as a generic. And that it works. We've been seeing, like just a good example, HIV patients living till a full life. However, the issue with that is that during those 10 years, poor countries can't have access to the drugs. But it works in that, look, we had the vaccine found incredibly quickly, drugs found incredibly quickly for the pandemic. Would we have such an efficient, innovative industry without such setup? Who knows? And we can debate this, but the system seems to be working for innovation. Ultimately, it just means that some countries will have to wait for the most innovative drugs.
Great. Thank you Marek and Ailsa. That's very kind, and thank you all for dialing in to this event. We have another presentation 10:30 tomorrow, a bit closer to home, Edinburgh Investment Trust, a UK focused trust managed by James de Upper. That will be starting at 10:30. Details are on our website. Thank you very much again, Marek and Ailsa, and see you soon.
Thank you for having
Thank
us.
you.